You want to know something that took me years to actually understand? There is a specific date every single year when you finally stop working for the government and start working for yourself. For most people earning a decent salary in this country, that date lands somewhere in the middle of May. Think about that. From the 1st of January right through to spring, every hour you work, every early start, every late finish, all of it goes straight to HMRC. You don't see a penny of it. And here's the part that really gets under my skin. The people at the very top, the ones with private jets and property portfolios, they are not doing this. They're not sat there in May finally clocking in for themselves. A lot of them are paying a smaller percentage of their money to the taxman than the nurse, the teacher, or the mid-level manager watching this right now. And it's not because they're breaking the law. It's because they understand 3 words that almost nobody with a normal paycheck has ever been taught. Buy, borrow, die. Stick with me for the next few minutes, because once you see how this works, you genuinely cannot unsee it. It changes how you look at every payslip you'll ever receive. Let me start with why you're losing, because you need to feel the weight of it before the solution makes sense. If your money arrives as a salary in the United Kingdom, the tax system is essentially built with you in mind. You are the target. Before that money ever touches your account, income tax comes off. National insurance comes off, and if you went to university, your student loan takes another slice on top. It's all gone before you even open your banking app. And the rates get sharp fast. Earn over £50,270, and every extra pound is taxed at 40%. Push past 125,000, and you're into the 45% band. But here's where it gets genuinely strange, and this is the bit almost nobody talks about. There is a hidden tax rate in this country that is worse than the top rate, and it isn't written on any official document. If you earn between £100,000 and £125,000, you start losing your tax-free personal allowance. For every £2 you earn over that 100 grand line, you lose £1 of your allowance. Add that to the 40% you're already paying, and the real rate on that slice of income is 60%. Throw in national insurance and you're looking at 62%. Let me say that again slowly. There are people in this country earning good money who hand over more than 60 pence of every extra pound they make. And the number of people caught in this trap has exploded. A few years ago, it was around 300,000. Now it's well over 1 million. So let's talk about how you got dragged in there, because you probably didn't ask for it. It's a phenomenon with a very dull name and a very expensive effect. It's called fiscal drag. Here's how it works. The thresholds, the points where you jump into a higher tax band, have been completely frozen since 2021. Frozen, not moved a single pound. And originally, we were told this would end in 2028. But in the budget at the end of 2025, the freeze was extended all the way to April 2031. That's a full decade of thresholds standing perfectly still. Now, inflation didn't get the memo. Your wages have crept up. The cost of your weekly shop has shot up. So every year, a little more of your income spills over into the next tax band, even though you're not actually any richer in real terms. The independent forecaster, the Office for Budget Responsibility, reckons this freeze will drag millions more people into the higher rate of tax by the end of the decade. Millions of people paying more without a single politician ever standing up and announcing a tax rise. That's the beauty of it if you're the Treasury. You freeze a number, you say nothing, and inflation quietly does the collecting for you. It's clever. It's just not clever for the person who got a cost of living pay rise and watched half of it vanish into a bracket they weren't even in last year. Now, let me show you something that I think everyone should be shown at least once. Let's follow the life of a single pound that you earn. Just £1, from the moment it lands in your hand to the moment it leaves this world. You earn it. Income tax and national insurance take their cut immediately, so you're down to roughly 60 pence before you've done anything at all. Then you spend it. On most things you buy, VAT takes 20%, so that 60 pence is now buying you about 48 pence worth of actual stuff. Put fuel in your car, and there's fuel duty, and then, wait for it, VAT charged on top of the duty. You are literally paying tax on a tax. That is not me being dramatic. That is genuinely how it's structured. You save up and buy a home. Stamp duty takes thousands just for the privilege of signing the papers. You sell an investment down the line, capital gains tax turns up. And then, at the very end, you die. And even then it isn't finished. Inheritance tax can take 40% of your estate above the threshold. Money you already paid tax on when you earned it, when you spent it, when you saved it. By the time that single pound has travelled through your entire life, the state has taken 70, 80, sometimes 90 pence of it. And nobody ever lays that journey out for you in one go, because when you see it all at once, it's genuinely staggering. Okay, that's the game when you play by the standard rulebook. Now let me show you what the wealthy are actually doing, because it is far simpler than you'd expect. There are essentially three moves. First, they don't take big salaries. A lot of wealthy business owners pay themselves almost nothing on paper, often right around the personal allowance, so there's little or no income tax. Their company might be turning over millions, but their personal income looks tiny. Second, they put money into assets instead of pulling cash out. Rather than extracting money and getting taxed on it, they use money, or more often borrowed money, to buy things that grow. Property, shares, other businesses, assets that quietly rise in value while they sleep. And third, and this is the crucial one, they don't sell. The moment you sell, you create what's called a taxable event, and capital gains tax comes knocking. So instead of selling, they borrow against what they own. They get their hands on the wealth without ever triggering the tax. None of that is complicated, it's just not part of the conversation most of us grew up hearing. And that gap in what people know is exactly where the divide between the rich and everyone else begins. So let's put the whole thing together properly. Buy, borrow, die. Stage 1. You buy. You acquire an asset that appreciates over time. In this country, property is the classic example, but it could be shares. It could be a slice of a business. And typically, you buy it with leverage, a mortgage or a loan. You're using the bank's money to control something valuable rather than draining your own pocket. Stage 2. You borrow. This is where it all clicks into place. As your asset climbs in value, you borrow against that growth. If you own property, you'll know this as refinancing. And here is the single most important sentence in this entire video, so let it land. A loan is not income. You do not pay income tax on borrowed money. Let me walk you through a real example so it's concrete. Say you buy a property for £200,000 with a £150,000 mortgage. Over 10 years, it rises to $400,000. You refinance at 75% of the new value, which gives you a new mortgage of $300,000. You pay off the original $150,000 and you've just released £150,000 in cash into your hand. There was no sale, no capital gains event, no income tax, because it's debt, not income. And if you take that money and do it all again, buy another asset, let it grow, borrow against it, the pot gets bigger every cycle while the tax bill stays flat at zero. Stage 3. You die. Bit blunt, I know, but it comes for all of us, and this is where the strategy completes. Your assets pass to your children. The debt attached to those assets reduces their value for inheritance tax purposes. And with careful structuring, the tax on what's passed down can be reduced dramatically, sometimes wiped out entirely. So across your whole life, you accessed your wealth through borrowing. You never sold. You never triggered capital gains. And what's left transfers in a way that minimizes the final bill. That's the strategy. Simple and completely within the law. And this isn't theory. This is documented behavior among some of the most famous people alive. When Elon Musk needed billions to buy Twitter, he didn't sell a pile of Tesla shares because selling would have detonated a massive capital gains bill. He borrowed against the shares instead. When Jeff Bezos was running Amazon and worth over $100 billion, his actual salary was reportedly around $80,000 a year. His wealth sat in stock, and when he needed cash, he borrowed against it. And closer to home, when Adele bought a house worth tens of millions, she reportedly took out a mortgage rather than paying cash, even though she could easily have paid outright. because paying cash would have meant selling assets and triggering tax. A mortgage costs a few percent in interest. Selling could cost 20 or 40% in tax. The maths isn't hard. Now, obviously, you and I are not shopping for a £50 million mansion, but here's the thing that matters. The principle scales all the way down. A landlord with 2 flats in Leeds is running the exact same fundamental strategy as a billionaire. Buy an asset, let it grow. Borrow against the growth. Don't sell. The numbers are wildly different. The mechanics are identical. So the obvious question, how does a normal person actually start using any of this? Let me give you 4 things. First, if you run a business or you're self-employed, get a specialist accountant, not a generalist who does a bit of everything. Someone who genuinely understands extraction strategies and structuring. The gap between an average accountant and a genuinely good one can be tens of thousands of pounds a year. The people at the top aren't using a high street bookkeeper. They're paying serious specialists, and it pays for itself many times over. Second, start thinking in assets instead of income. Run every financial decision through one simple filter. Does this pay me once, or does this build something that keeps paying me? A salary pays you once. An asset compounds. That single shift in thinking changes everything over a lifetime. Third, separate good debt from bad debt in your head, because they are not the same animal. Consumer debt, credit cards, car finance, buy now, pay later, that stuff is a drain. Get rid of it. But debt attached to an appreciating asset where somebody else is covering the repayment, like a tenant paying your mortgage, that is not a liability. That is a tool. And fourth, understand that you can start this at any age. It genuinely doesn't matter whether you're 22 or 52. Most people never get around to learning how wealth is actually built, so the simple fact that you've watched this far already puts you ahead of the crowd. But before you go, I want to add 2 things that make this even more urgent right now, because the rules are tightening as we speak. Here's the first. For decades, your pension was one of the great escape hatches. Money in your pension pot generally sat outside your estate, meaning it passed to your family free of inheritance tax. That is ending. From April 2027, most unused pension pots will be pulled into your estate and counted for inheritance tax. That is arguably the single biggest shift in estate planning this decade, and huge numbers of families have no idea it's coming. And here's the second. That inheritance tax threshold, the amount you can pass on before the 40% bites, has been stuck at £325,000 since 2009. Not 2019, 2009. And it's now frozen until at least 2031. Think about what a house cost in 2009 versus today. The threshold stood perfectly still while property prices marched upward, which means ordinary families, people who would never call themselves rich, are being quietly pulled into a tax that was originally designed for the wealthy. The wealthy, of course, planned around it years ago. So let me finish with something I think needs saying plainly. The UK tax system isn't broken. It's working exactly the way it was designed to work. It was built to tax labour, to tax salaries, to tax people who trade their time for money. And it does that job with ruthless efficiency. What it was never designed to do in the same way is tax wealth. The wealthy buy assets, borrow against them and pass them on. They don't sell. They don't create taxable events. They're not bending the rules. They're just using the rules exactly as they're written. And to be crystal clear, I'm not telling you to dodge tax. I pay mine. I'm glad to contribute to the hospitals and the schools we all rely on. What I'm telling you is this. Don't pay a single pound more than you are legally required to, because I promise you the wealthiest people in this country certainly don't. Buy, borrow, die isn't just a clever trick. It's an entire way of thinking about money that most people are never once exposed to. And now you have been. If this shifted something in how you see your own money, do me a favor and subscribe, because this is exactly the kind of thing we break down here every single week.